Hello everyone, and what exciting times we live in. Was that just the top of the US stock market? I must admit, I didn't expect the latest rally, so I could be again crying wolf a little bit, but there's an awful lot wrong with the fundamentals of the US economy, and there are increasing tensions with risk of further escalation occurring, unfortunately, with regard to the Ukraine-Russian conflict. All of that could push commodity prices higher, which would mean that when the Federal Reserve hikes one more time, perhaps it won't be the last. Now, I think probably it is, but the risk is for a further Fed hike after its last hike rather than rate cuts. So in other words, the probability of the Fed moving higher after its next hike is higher than the probability of it cutting rates. At the very minimum, I think US Fed rates are going to be very sticky at current levels, and I forecast one more rate hike with another 12 to 18 months of hold. So it's a long way out before their next move. The only thing that would prompt an earlier move is not a slowing of the US economy, which I expect to occur, nor is it a fallback in inflation, because they wouldn't have to go through the same process experience again. They will hold rates where they finish for a very long time. And I think people need to adjust to the permanency of these higher Fed rates relative to recent history. But in the long-term history of things, this is about normal. So I know for a lot of people, they haven't experienced interest rates as high as these levels, but they certainly usually historically are, in fact, even higher. So the Fed will be on hold for a long period of time, and the risk over the next 3 to 6 months is actually a second Fed hike. This is not something markets have really grasped, and I think there is a vulnerability here because it's front page news that the US stock market just made its 9th consecutive day of gains, and yet on that same day, the Nasdaq fell back 2%. So it could be this tech-driven, I call it the total control AI rally. In other words, investors favoring those companies that are likely to maintain a global grasp of their markets, like Microsoft, Google, Apple, Meta, etc. And then the AI stocks like Nvidia and, to a certain degree, Tesla. Now, the caveat on Tesla is that the electric vehicle euphoria may only last another 3 to 6 years. Because VW and BMW are already road testing fleets of hydrogen cars, which are just so much more beneficial to the environment than electrical vehicles. Did you know that an EV requires 6 times the amount of mining? And the break-even point in terms of CO2 contribution to the atmosphere is at about 200,000 miles for an electric vehicle. In other words, until you reach that sort of mileage, the petrol-driven car is actually more beneficial to the environment because it requires so much less mining than an electric vehicle, and it doesn't produce the toxic outcomes that batteries do. That's further down the track. Those comments I just made now are not going to become mainstream anytime soon because everyone in the mainstream media, the people and in the investment banks, they've all bought EVs. So the last thing they want to hear is that their resale value is going to plummet. And if you've bought an EV, you're not going to like what I'm saying, but it is better to be starting to think about this and not be the last person to leave the EV table in a few years' time because your resale value might not be as great as you would like. So this would be a major upheaval to the thrust of the narrative of our time, which is all about you have to have an EV for the planet and you're cool if you have one. I remember when the same thing was said about diesel cars. And now they're banned in some major global cities because of how toxic they are. EVs could have a shelf life, and everyone who's thinking of owning an EV should consider that. So there's risk to this rally in ways that people aren't really grasping yet. And whilst I'm trying to sell Tesla, I understand that it will be a while before the sorts of comments I just made are more apparently correct in the mainstream narrative. That process will be very delayed. But we do know that some of these stocks are way up on their earnings ratios, and we do know they've already had a very good run. And we also know that their earnings are starting to disappoint on the soft side. So all of this comes back into the major equity market indice views, if you like. Something I learned yesterday or a couple of days ago was the exact harsh reality that 7 stocks in the S&P 500 are up about 58% this year, while 493 stocks are up 4%. And of course, there's lots of individual stories within that. But it just goes to show how concentrated this rally has been. And it goes to show how very much meme trading is involved. So people just buying these technology stocks no matter what. And they've been proven correct this year. But can these kind of levels be sustained when the real economy of both the United States and the world is under downward pressure? And what if we get another commodity prices surge out of this renewed intensity, slight expansion, with Russia having shelled Ukrainian ports on 3 nights in a row now, and with Ukraine responding in a similar way? There is a real risk here for a fresh, sustained commodity price gain period in food and energy. I still like gold, even though the US dollar could have a bounce here. I keep saying that. I still like oil. And I'm just a little bit wary that this new development in Ukraine, and also really what has been a largely Ukrainian failure to take any new ground in this renewed offensive, all adds up to the risk of inflation resurgence that keeps the Fed on a tightening bias at least for the next 12 to 18 months, and perhaps a surprise second hike. And I worry about what that could do to market sentiment. On the upside of all of this is we really do have the financial instruments to be active with our investment portfolios. I think this is one of those acute times where active management is all important. So I hope you can make the most of those opportunities, and all the best for the weekend. Clifford Bennett, Chief Economist, ACY Securities.